Hello and welcome to the latest RSM coronavirus webinar. As part of our Reactivate and Reimagine webinar series, we are looking at ways to protect businesses and jobs, generate cash and obtain funding, and also streamlining operations, enhancing performance, increasing productivity through the likes of data analytics and technology. This webinar, though, is about debt finance and borrowing. Our aim is to help corporates better understand lender attitude in the current environment and therefore help business leaders get the best out of their relationships with their lenders and, most importantly, get access to all the facilities that are available right now. What we're going to do is, with the help of a panel of specialists, some from RSM and some from lending institutions, is discuss this topic and the results of our recent RSM UK survey of mainstream clearing banks, challenger banks, asset-based lenders, and private debt funds. That survey was completed by 182 lenders. And what's fascinating is that that survey, which was conducted between June the 29th and July the 8th, 2020, suggests some marked differences in viewpoints from lenders, which we will explore in a moment. Equally, lenders are being supportive, but even so, respondents to the survey indicate an expectation of increasing bad debts and rising corporate insolvencies in the months ahead. I guess on a more positive note, the survey also suggests a bullish view towards transaction-based funding and coronavirus-related support, but with differences in attitude and risk from lenders, hardly surprisingly. So understanding these nuances, perceived or real, should be beneficial to you to consider and understand today. So before I introduce our panel, can I just mention our Q&A function on this WebEx? Time allowing, I will ask our panel a selection of your questions, so feel free to send across at any time your questions using the function on the right-hand side of the screen there. In terms of our panel today, I'm Simon Hart and I'll be your host for the event, and I'm delighted to introduce the following panel members. From the RSM team, first up is Greg Morton, one of my RSM partners who leads our debt advisory practice, helping middle market businesses raise debt finance. This includes general refinancing, recapitalization, acquisition finance, and sell-side financing. Joining Greg is Matt Hoare. He's one of our London restructuring partners, which means working with lenders and clients to identify and diagnose problems in operational or financial activities, and then develop strategies to resolve and hopefully return those businesses to profitability. Hardly surprisingly, Matt is in demand right now. I'm also delighted to introduce our three guests onto our panel. I'll just say in advance that the views that they may well express are their own in a private capacity and may not therefore reflect the views of the organisations they represent. So first up is Alistair Jemmett, a Senior Director on the Acquisition Finance team at CYBG plc, the UK's sixth biggest bank, which includes Clydesdale Bank, Yorkshire Bank and Virgin Money. Prior to this, Alistair spent 20 years at Barclays and works closely with private equity and corporate clients, supporting with MBO finance and acquisition finance. Alan Cousins is Chief Operating Officer of Lumi ABL, a position he's held since the heady days of 2008, and Alan has over 35 years' experience of the asset-based lending industry. Alan tells me that Lumi ABL specialises in structured asset-based lending facilities of between £1 and £40 million, backed by a high client service provision. And finally, Donald Campbell is Senior Vice President at Precoa Private Capital, where he is responsible for their junior capital strategy, investing subordinated debt and minority equity into situations, including LBOs, MBOs, recapitalizations, shareholder buyouts, and growth financing across the UK and continental Europe. So that's our panel. Let's now look at the agenda for this afternoon. We're splitting the discussion into two main areas. What's happened so far with government schemes and other measures, and then we'll move on to the Reactivate and Reimagine phase, the looking forwards piece. We'll then conclude with some final thoughts from our panelists and observations, and then as time allows, your questions. Finally, this session is being recorded and it, together with the slides, will be made available afterwards via visiting the RSM UK Coronavirus Hub, so please go to rsmuk.com, where you'll find access to all our other previous webinars, event material, and content. Right then, that's enough from me. Greg, let's recap and reflect on what's happened up until now.
Thank you, Simon. So let's get going through the survey results. So I call up the first page there. Five pie charts. It's a lot to take in at a glance. So let's walk through this one a little slowly, I guess, as it's the first one. So first of all, as Simon alluded to, we invited the respondents to self-declare themselves as one of four categories: a clearing bank, so a high street type lender; what we call a challenger bank, so one of the newer banks in the market. We invited those who are specialist ABLs, asset-backed lending funds, to declare themselves as that. And finally, private debt funds, so funds taking pension and similar money to invest in the debt markets, a little bit similar to private equity, but investing in loans, was the fourth category of lender in the market. You'll see there are 5 pie charts on this page. That's just because for this purpose and on a couple of other ones, we've compared the results from our private equity survey that we did a couple of weeks ago. So this first question is around CBILS, so the Coronavirus Business Interruption Loan Scheme, and the CL bills, the extra L being for large, i.e. the government subsidised lending schemes. And we said to lenders, okay, what proportion of your customers have applied or is likely to apply for a CBILS or CL bills loan? And the results are interesting. They certainly surprised me slightly. There's a big preponderance of green, which is i.e. lenders saying, well, I think less than 25% of my customers is going to apply for those loans, which I found fascinating. I thought clearly the take-up would be much higher than that. The only one which sort of showing anything like the take-up, I suppose, is the clearing banks, where the 25 to 50 is a high proportion, and quite a lot in the black, sort of the higher ones. So a little bit surprised by that. Another sort of facet, I guess, maybe not such a surprise, is the big 0% pie there under private debt, where many private debt lenders were saying their customers weren't accessing the CBILS market. So maybe first off, get a reaction on that from Donald at Precoa Private Debt as to whether is that fair? Is CBILS incompatible with private lending?
Good afternoon, everybody. Thanks, Greg. I think if looking at our portfolio, I think what the answers or the way the pie set, the chart is set out, we've probably seen a quarter of our portfolio companies looking at, or thereabouts looking at CL bills and CBILS. Hasn't been, the outcomes haven't been particularly, satisfactory, I suppose. The CBILS is structured such that it's a relatively straightforward application process. And given a lot of our companies are structured in a kind of, like a private equity LBO kind of deal structure, where you've got a relatively complicated equity capital structure, that we found that has been incompatible. So the complexity of the financing structure for a CBILS at least was very difficult to match to the actual application process. On the CL bills, bearing in mind that a lot of what we do is we provide a subordinated debt, junior capital, and ahead of that we can put senior debt or ABL. We've had, I think, where we've applied for it, we've had better success. But broadly, the reason the portfolios haven't applied is that that we have a relatively young portfolio, and it's the businesses by and large have been relatively unaffected, I suppose. So we've been probably fortunate in not having to access CL bills. I think where we've had to do it, the challenges of putting capital in that may rank ahead of us. If in a sponsor situation, we would prefer the sponsor to put capital in. And then there's a complexity around some of the rules that have been set for again, which sort of prejudiced leverage structures, particularly the EU State A rules, which effectively mean you need a certain amount of positive part of equity.
Kind of maps through into the private equity point, I guess.
It does, absolutely, and that has made life, very difficult. And effectively, in terms of going to certain banks, it's cut down the number of banks we think would actually take a favourable view, of a kind of leverage structure.
And of course, on CBILS, you typically have to go to your own bank. So an interesting one to kick off there. I think. I mean, personally, I think there's more to come on CBILS. That survey indicating pretty low take up. I would certainly expect that to increase as some of the other government subsidies come away over the summer and firms look at that. And also more and more lenders get happier with lending into the private equity type structures. We'll look now, I think, next at, as opposed to CBILS, CLBILS, kind of what new money might or might not be going into businesses, just simply at how are lenders reacting to debt in their in terms of the debt that's already out there, already out to clients who are almost certainly suffering to some degree under the coronavirus situation. So first of all, over to Matt for the ABL angle on this.
Yeah, so hello everyone. In my experience as a restructuring expert, working a lot with lenders, I'm always very pleased to see that lenders try to be as supportive and as imaginative as they can be to work with their clients to maintain the working capital. Coronavirus has had an interesting impact that turnover has been impacted for a lot of businesses, which when you're funding using invoice discounting can reduce the funding available to you. But I think what this slide shows is that the survey suggests that ABLs have been coming up with lots of ways to help their clients through, whether it's waiving their lending covenants, increasing facility advance rates, relaxing some debt term targets. So I was wondering, Alan, maybe you could share with us some of the factors that you consider when you're working with your clients as to how you can support them, what support they might need, and how you provide it.
Yeah, thanks, Matt, and good afternoon, everyone. I think our clients will remember how lenders act and the support that we show throughout this time. At Lumi, we're lucky enough to enjoy some very strong relationships with our clients and have a staff-client ratio which allows us to know our client well and to understand their needs and have been able to work with them to provide the forbearance that they've needed. I think waiving covenants and providing capital repayment holidays was necessary and inevitable to give our clients the space and time to take the measures they need to protect their businesses and their staff's well-being without the worry of how we as asset-based lenders might react. As always, good communications between the lender and the client is vital, and we've particularly welcomed those clients that have come to us proactively with their strategy of the actions they're taking to protect the business, the welfare of their staff, and are able to give us the assumptions on how their circumstances might be affecting the asset performance and the impact on all the cash drivers, together with any other measures that they may be taking to preserve cash, such as approaching HMRC for VAT, PAYE deferrals, rent holidays and the like. And as a result of all that, we've been able to understand our clients' debtor and asset performance, their cash drivers, and we've been able to grant the covenant waivers to all of the clients that have needed them. And where additional support has been needed, we've been able to offer prepayment holidays on the term facilities, extensions to their prepayments and advance parameters, and indeed CBILS facilities to allow them the time and indeed the headroom they need to get through this.
I think what we're saying there is early communication and a collaborative approach usually is the right way forward to get the right outcome for the client.
Exactly that. Transparency and early communication is always good.
Interesting. Okay. And in terms of the cash flow angle then, on the next page, how are cash flow lenders reacting? So the bar charts are, what measures have you taken to assist your clients in coronavirus? The biggest bar, I have to say, is no surprise at all, covenant resets. Nearly 90% of lenders granting that. That seems absolutely in line with my thinking, what I would have thought. Capital repayment holidays, pretty high. Possibly higher than I would have thought, but again, well, that's not true. Higher than I would have thought going into this crisis, because I think normally lenders are pretty reluctant to give up on repayments, but it did soon very much become a feature of the crisis. The one that surprised me, I have to say, is quite a long way down that table, which is interest roll-up. And certainly, when I was at banker school many years ago, it was a a pretty firm rule that whatever else you did, you wanted your interest paid current, and that was a real test. If a company wasn't paying your interest covenant, that was a sort of big boundary line you didn't want to cross. So I was surprised to see as many as 35% of lenders saying that they're ready to do that. I don't know, Donald, what do you think?
Well, I would say, we've done all of this pretty much. I think the demand shock from the lockdown was dramatic, and a couple of our portfolio companies effectively went revenue dark, and we had no choice. And frankly, we are supportive and kind of long-term relationship people. So the immediate reaction for across particularly really badly affected companies was to, as we've said, grant waivers, resets, have to do that. But in where interest roll-ups were necessary, we've done that. And I agree with you. It's a significant issue for a bank to defer or waive interest payments. But through the second quarter, it's something we've done. We've where it's possible, we've tried to put catch-up provisions in place. And this is on the senior component of the kind of senior-junior hybrid that we put in place. On the junior side, which is a subordinated debt instrument that has some element of cash pay, almost universally where there are issues, we turn the cash pay piece off. So the point being is a combination of an amortization on the print or an amortization holiday on the principal plus the cash pay deferral actually takes a huge amount of cash burden off the business.
Yes.
I think we're now hopefully going into a phase of exiting the lockdown and hopefully the economy exiting the current situation where we can actually take a long-term perspective on covenant resets and and managing more structured payment situations, including, as you say, with trying to avoid interest rolling up.
So basically, I think summary here: a lot of rules have been broken. The capital repayments normally hard to get became easy to get. Interest roll up normally an absolute total no-no. A third of cases apparently are getting that. So it surprised me, but exceptional times, exceptional approach. If we move on to the next section, if you like, looking forward, what is it that lenders expect to see, expect to do, and borrowers should prepare for as we go over the next year and we begin to look forward to 2021? What does that hold? How are we going to get things back onto their feet? So the opener, probably another big page of pie charts. So we should certainly take our time on this one. This is simply asking lenders. So if you forget C-bills for a minute, kind of bailout type money, bailout things in terms of covenant waivers and other things on existing debt. When do you expect, we asked lenders, to get on and get back into the market doing what it is you basically prefer to do, which is those big loans that support the major events, the M&A or the other big occasions in a company's lifetime, as it were. And actually, we found, I was a little bit surprised almost, maybe not. I suppose lenders, quite often an optimistic bunch, really quite short time frames, quite a lot of blue there, certainly on the private debt funds, specialist ABL, saying, look, expecting to get back into the market and do an M&A deal in the next month or so. But even if you go into the green 1 to 3 months, which is not long, 1 to 3 months is basically saying kind of after the summer, basically September, you expect deals to get going. That green slice getting quite a long way around the dial. Maybe a little bit more cautious on the clearing bank side, quite a lot more in the 3 to 6 months categories there. I don't know, a view perhaps on the banking front. Alistair, what do you think, first of all, in terms of what's your take on that? When do you next expect to see an M&A type deal, or have you even done one already?
Yes, good afternoon, everyone, and thanks for inviting me onto this panel. It's an excellent survey with some very thought-provoking results. So yes, Greg, in terms of the survey here, the results show that 41% of clearing banks will deploy capital over the next 3 months. And at Clydesdale, Yorkshire, we're very much in growth mode, having acquired Virgin Money just over 18 months ago. And we've already been deploying capital to support new-to-bank, event-driven M&A transactions. And over the last 3 weeks in our London acquisition finance team, we've completed 2 separate financings for private equity and corporate deals, which we're very pleased with. And we've also got a pipeline of new opportunities that we're working on across all of our UK offices. And so we hope to be able to deploy further capital and support more companies in the very near future.
And Alan, what about you on the ABL front? Is Lumi expecting to support M&A, or is it more about working capital and other matters in the current climate?
I think I agree entirely with the specialist ABL pie chart. We're seeing a number of opportunities. Indeed, M&A event-driven transactions are ideal for the asset-based lending community. I've gone out to my sales team, and across the team, they're looking at 23 live deal opportunities at the moment, of which 7 are event-driven. And 4 of those we actually expect to complete within the next 3 months, and we have a high degree of confidence around them. With regard to transactions, we've seen one transaction which we've completed so far, where a management team recognised early on into the pandemic that their financial structure was unlikely to be robust enough to see them through. So they sought some assistance and got another trade business involved to allow them the time and support to be set fair as we come out of COVID.
Interesting. Okay, and Donald, what about you? Are you likewise sort of getting back into the market as fast as we've heard from the other two?
Oh, yes, we never left, and it's really a function of pipelines, I suppose. Looking at the private debt fund pie chart, if you close a deal within the next month, probably had it on your. It was probably something you were looking at pre-COVID, given the time frame or the length of time it takes to do a deal, and we're certainly seeing an uptick in opportunities, both sponsor-backed and non-sponsor, which is really the core of what we do. And the MBOs, carve-outs, as well as kind of growth plays, both UK and in continental Europe. Being cautious, I think, diligencing during COVID is going to be a challenge. So we're cautious in terms of our approach, but we have a significant fund to invest, and looking at opportunities and willing to take risk in the current environment.
So September, everyone is looking forward to September, I guess, and that's the debt market. We often like to say is it's a little bit seasonal. It kind of runs in school terms, September, January, and April. But I think we'd support that too, I guess, in terms of things beginning, bit of beavering over August, and people expecting to get back into the market in September. So in terms of, obviously, lenders do have a duty to think about credit, think about reasons why deals might go wrong, because that's their job basically. So we do have to look at that angle of things as well, even when contemplating interesting new deals. So over to Matt, really, to ponder that and what lenders said in terms of what was keeping them up at night when they looked at new deals.
Yeah. So again, interestingly, asking the lenders what are the challenges in deploying their debt capital. I think one that's quite telling there, the lack of time spent with management, I think is a real indication that how well everybody has adapted to what is the buzzword, the new normal. Before, I always like to work with people, face to face with people, being able to spend time with people to understand what was going on. But I think this survey clearly shows that we have found ways of working with people remotely, and that's not a major barrier to deploying debt. In terms of what is, obviously, borrowers' trading performance, always at the forefront of decisions. But the second largest is concerns regarding what happens with a second wave, and how do we might survive one wave, what happens with the second wave. So, Alistair, what are your thoughts on that? Do you agree with these barriers, or have you got other views?
Thanks, Matt. Yes, I do agree with this actually. So the borrower trading performance and the prospect of the second wave are definitely the two biggest issues here with these results, and I agree with all. But from my perspective, it's how companies can demonstrate to their respective financiers their own resilience to COVID and how they're able to mitigate these issues that we've seen over the last few months. So clearly the potential second wave has obviously been very much in the news over the last few days. And so showing what steps that businesses can and have already taken to counter this, if this does arise again in the future, is really key to getting potential lenders on board. However, we have also seen the evidence of the significant levels actually of support in financing companies through these uncertain times over the last few months. And you would have seen that the British Business Bank actually confirmed this just a few days ago, that government-backed loans have already been granted to over 1 million companies across the UK, which totaled £45.3 billion. And at Clydesdale, Yorkshire, we were very much proud to be one of the 40+ panel-approved lenders in supporting our clients through these difficult times. So hopefully this will prove beneficial to businesses going forward.
Excellent. Yeah, thank you very much. And I think it is useful. We all have to keep our mind on what is going to stop us getting access to markets and be able to adapt to them accordingly. So as part of that, just moving on slightly to looking at the ABL specific challenges and the government's impact on ABL lending. There's been a number of potential initiatives that were due to come in have been deferred, and we were interested to see how they would impact ABL's ability to lend most. And what is quite clear here is that HMRC's promotion to preferential status in insolvency that was due to come in a couple of months ago and has now been deferred to December, looks like it's going to have a very significant impact on the ability to put debt out. When you tie that into the level of HMRC, PAYE, VAT debt that has been deferred in the period up to the end of June, you could see that that's potentially going to be a rather large blockage in the debt market. So, Alan, have you got views on this?
Yeah, I think that's right, Matt. The reintroduction of the HMRC's Crown Preference and combining that with the changes that are arising from the Corporate Insolvency and Governance Act do provide quite a significant restriction to be able to lend against assets that are secured by floating charge, such as inventory stock. You know, it's funny on one hand that the government gives tax forbearance to companies, which means floating charge lenders effectively have to react and reduce lending sometimes on a pound-for-pound basis. But then through C-bills and CL bills, the government then provides a guarantee to the lender, and then the lender gives the funding back to the company. It's a bit of a bureaucrat's dream. So I'm going to watch with interest what comes along to either extend or replace the C-bills and C-bill schemes, because I think it has to go beyond October. Whilst in the near term, the clients and the lenders need to work together to find solutions to get creative with the assets that we can lend against. And looking further ahead, I think we're going to have to be even more inventive and think of the ways to use technologies and legal structures to find ways to lend, which mustn't, I guess, breach the spirit of what the government has intended with this measure.
Certainly, but in the interim, looking at large deferred PAYE and VAT and Crown debts, I think we would probably all agree could have a potential impact on not being able to lend to businesses without some clever structuring.
Indeed.
So back to you then, I think, Greg.
Yes, indeed. The next one, another sea of pies. So this one, I'll sort of pause a bit. There's lots to digest at a glance on this page. So this question, it's quite a long question, but it's a real question. This actually came up from one of our clients a month or so ago, so that's why we've asked it. So, and what it is, so the question is basically, imagine you have a company that is somewhere on its V-shaped or U-shaped or any other letter you pick journey from having been actually fairly badly affected by the virus. Maybe it was shut down altogether for some shape or form, and is now on its way back up. So it's not a company that sailed through. It's a company that's on its way back up. And we said to lenders, okay, on that basis, how many months of kind of recovery, of pre-lockdown level performance, of strong recovered or on its way performance do you expect to see in order to lend based on the pre-lockdown EBITDA? So the reactions here you can see quite different across different sort of categories of lenders. So this is a little bit of an advert, I suppose, for the ABL way of doing things, because the biggest pie there you can see the blue, no requirements for that. Obviously reflects the way that ABL lenders look at what invoices have you got today. That's what I'll take as my lending basis, rather than thinking about performance and cash flow and forecasts as much certainly as cash flow lenders do. Apart from that, so interestingly, again, quite a few challenger banks, possibly because they've got an ABL kind of capability, sort of put themselves quite a lot in that blue category. But otherwise, certainly the clearing banks and the private debt banks, probably a bit more cautious. The sort of the winning pie slice was very much the pale grey. People, if you had a business that was on that trajectory, you would certainly want to be waiting for 3 to 6 months of data. So very interested to hear the panelists' feedback on that. Do they have a real situation that reflects that? And of course, it's interesting to compare it, of course, back to that question we had a few slides ago. When do you expect to get an M&A deal? Everyone's feeling gung-ho about getting back into the market in September. Presumably, if we compare these two, that's for businesses that have sailed through the crisis, if you like, whereas businesses that haven't may have to wait, talking about December, I suppose, before anyone will lend the money to do something on their basis of their recovery plan. So why not let's go to Alan first on this one. ABL, a superior system?
Well, it's certainly an area where asset-based lending sector does come into its own. You're absolutely right. Because whilst viability is of course important, ABLs are less interested in EBITDA performance and much more focused on asset performance. And therefore, where we have the right pool of assets, we can react really quite quickly and flexibly to leverage that asset pool on the balance sheet and structure the facility, which gives the management time and the headroom to take the appropriate actions. Donald's earlier point about diligence is of course a challenge. Matt's point about being able to meet face-to-face is a challenge, but we're getting through that. With the use of WebEx, with the use of Microsoft Teams, and the use of file sharing platforms such as SharePoint, we're able to get the meetings and the quality of information that we need from our potential borrowers to be able to make fairly swift judgments and do our due diligence in a way which allows us to react really quite quickly.
Thanks, Alan. Alistair, what about you? Are these different groups of borrowers we're talking about here, the September group and the December group, or can you square that circle?
Yeah, thanks, Greg. Yeah, in my view, these survey results do seem fair to me. And clearly, if a business was evidencing strong trading pre-COVID, then that's certainly going to be a positive to banks and the lending market generally, because it's perfectly understandable to see a dip in businesses trading since COVID began a few months ago. And clearly, if a company can also show that it is now in recovery, backed by recent trading results, combined with mitigating action taken by the management team bearing fruit, then this will be well received by the lending community. And we certainly would be looking to help and support businesses as much as possible, basically during this period, and also looking further ahead.
Thanks, Alistair. Donald, what about you? We tend to think of private debt as pretty gung ho. Shouldn't there be more green in the pie there?
I mean, I agree with Alistair. Really, I think well-performing businesses before, if they bounce back quickly, there's no reason not to be serious about financing them. I think rather than this concept of pre-lockdown EBITDA is not one that we're really thinking about. And again, go back a couple of slides, really looking at, what is the next 12 months as opposed to the last 12 months prior to COVID I think is the right way to look at, EBITDA, projected EBITDA, cash flow against which we can lend. So that's sort of what we're focusing on. But as you say, if a business is trading strongly and has bounced back, we have the risk appetite to finance it. I think the key is, as we've said on other sides, is communication, being close to the client, being close to your portfolio company or your prospective company, understanding, who they are, and that is always, that's going to help us understand and get close to them and kind of hopefully make the right credit judgment. I think, severe negative, we've in the portfolio companies that have done, extremely badly. They're coming back slowly, and there's a large group of that, I think, out there. We've seen prospective opportunities where, businesses have had, have very poor balance sheets, and those are the businesses where you're going to just have to take more time, if time allows. So there is certainly categories of businesses out there, and finance will follow, and good businesses will attract capital quickly.
Thanks, Donald. That's interesting, and actually, obviously, there's a lead time on this. We wrote these questions probably 4 weeks ago now, where there was probably more talk of bouncing back, as it were, and getting back to where things were, and it very much reflects, I think, where we are now as we head into the summer. This point about which letter is the shape of the recovery, or indeed are some businesses permanently changed, in fact. So I think that's a very good point, actually. We really should be thinking about future EBITDA perhaps than past EBITDA. Or rather, past EBITDA maybe is no longer as good an approximation for future as people hoped it would be as we went into the crisis. I think now a slight sort of shift of topic, just as we head towards really looking to the future and how lenders are going to assess the market. But before we do that, over to Matt for a bit of background, I suppose, in terms of how a lender is going to be thinking and feeling opposite borrowers in the autumn, as perhaps bad news begins to come through and crystallise in their portfolios.
Thanks, Greg. So a lot of positivity so far from the lenders as how they're looking to support, how they're looking to deploy new capital. But we did ask our respondents what they expect the volume of UK insolvencies over the next 18 months would be. And you'll see from the pie on the right there, whilst there was the opportunity to tick no change or a decrease, pretty much, 100% of our respondents is expecting to see either a slight or a significant increase in UK insolvencies, which will have an impact on all of us, whether that's our customers entering insolvency, giving us bad debts, or whether that's people in our supply chain causing us supply headaches. Clients do need to understand what their action plans are to avoid being succumbed to insolvencies around them. But in particular for lenders, I think what's interesting from the question on the left, where we asked lenders how they saw their bad debt provisions changing, a marked difference between clearing banks and other lenders, whereas clearing banks are, I think, or 50% of them are expecting their bad debts provisions to increase significantly compared to only 14% of other lenders. So probably one for you to start with, Alistair. Do you agree with that? And if so, why do you think clearing banks are expecting their bad debt provisions to be worse than other lenders?
Thanks, Matt. Yes, I think all banks tend to differ on this. Some wearing worse than others, depending, of course, on their own portfolios. And yes, I can understand why the survey may indicate this, because of the specific asset security base that usually sits behind ABL financing, as Alan from Lumi mentioned earlier. We also do ABL here at ICL in Yorkshire, and as a bank, we announced our group half-year results under the Virgin Money PLC name just a few weeks ago, and our CFO confirmed at that time that we do have a prudent COVID provision and also a robust capital position going forward. And then turning to the potential insolvencies that we mentioned on this slide, Matt, we've already seen the problems that companies have faced over the last few months. And really these survey results show almost a 50-50 view on whether these will increase slightly or significantly. So companies really should try and plan for further potential adverse impacts from the economic downturn. Although, as I referenced earlier, unprecedented measures have already been implemented across the UK with over 45 billion in funding to date. So I'm hopeful that clearly this will help them with their cash flow going forward.
Thank you, Alistair. And Alan, do you agree with that viewpoint, or have you got a different view?
I do agree with that. I think ABLs are collateralized against the pool of assets. Because of the procedures that we have in place, we get to know them really well. And we work with our clients to monitor the performance of those assets such that surprises are typically limited. Of course, there can always be the unexpected debtor insolvency within the self-ledger, and only time will tell what will happen to term asset values such as plant and machinery. But it will be our intent to work with our clients to find a solution to get them through and to avoid crystallizing such a position. We often say here that a rolling loan gathers no loss. So whilst I think there will be an uptick in insolvencies, I think provisions across the ABL sector should be really quite constrained. And looking at our particular portfolio, it's performing well, and I at the moment can't see any provisions resulting from it. But I'm touching wood as I say that.
We'll all cross fingers, Alan. So I think it's back to Greg.
Yes, indeed. So final two slides then. Kind of what can borrowers expect to find in the market in terms of pricing on this one and leverage? We'll see in a moment. So what those two sort of crucial things that borrowers look for in a loan. You know, how much can I get? How much will it cost me? So this first slide then is pricing. We said to people basically, do you think pricing is going to go up, or is it going to go down, or is there going to be no change given the changes in the economic climate? So the surprise for me on this one, rather interesting, I thought, was just how much green pie there is, which this is to say no change. You'd think that markets become a bit more risky, more demand for capital, that there would be more in the basically the grey and upwards bars in terms of some sort of increase. I think, to be fair, of course, I think across all categories, if we sort of visualize the grey there, the grey is half or more than half. So most people do expect to see a price increase of some description. Probably the most popular slice being as much as 50 to 100 bips. The clearing banks perhaps a bit less than that. You know, below increases of up to 50 bips. Private debt probably, to be fair, proportionately quite a lot higher increases. I guess as the same or possibly even lower proportions depending on rate charged overall. So I don't know, Donald, what do you think of that? Are people pricing the market right just now? People being too cheap, maybe not putting their prices up enough given the change of risk? What's your perspective on that?
Thanks, Greg. We have an interesting example of the same company looking to borrow back in February, and now it's looking to borrow currently, and the pricing on that transaction, the current transaction, for what is a similar business actually has performed well over the period. Pricing is higher, by between it would have to fall between the 50 and 100 bits price increase. So I think that's very much a market-driven transaction. There are multiple parties involved in it, so it's not a bilateral or bespoke transaction. So I think the market generally has moved. I would say, and that's more on the senior side. That was a big senior direct lending stretch senior transaction for us. looking at the junior capital, the kind of subordinated mezzanine debt, I think what we're doing there as a strategy is the pricing never really changes. We're yield focused. What we're looking to do is actually just take probably slightly less leverage. So take a more conservative view on risk. And that implicitly that's a slight price increase, I guess, because you're putting proportionally slightly more subordinated debt into a transaction. But that's the way we're certainly doing it at the moment. But we're seeing for good assets, market is competitive. So pricing moving back to where it was for good assets, non-COVID impacted assets certainly.
That's interesting. So basically,
so very much it's a case by case, I think. But as I said, the transaction we looked at before and after, we've seen a bit of a price increase.
So you're, I think, basically saying maybe it's kind of swings and roundabouts. I guess the market is working reasonably well in that. Yes, times are riskier, but there's a whole lot of lenders out there, be it private debt or banks or others who want to lend money, as we've already heard. So that maybe evens out to what we see in the pie charts here, with a little bit of a bias towards prices going up, but some equally saying it'll stay the same. Final category then, in terms of what to expect, is leverage multiples. Again, here I was a little surprised by the amount of green, really quite dominant in these pie charts. So green being suggestion that no change to leverage multiples. So in other words, the multiple of debt that lenders are willing to put against the EBITDA, the earnings of a business. One might have expected lenders to be more cautious, if you like, in the current climate and lend less of a multiple of the earnings of the business than they otherwise would have done. But really quite significant numbers saying actually I'll use the same multiple. What we didn't ask, I suppose, and maybe behind this a little bit is, well, of course, which EBITDA? If EBITDA has gone down, then arguably you're lending the same against the same company, even if, because EBITDA has done the job for you, that's gone down, so you can lend the same multiple. Alistair, how are you looking at that? Is this a kind of clumsy shorthand that doesn't tell us anything, or is there something to be gained from looking at multiples and views on those?
Yeah, thanks, Greg. So for these survey results, yes, 42% of clearing banks are saying effectively no change in credit appetite on their multiples, which I'd say is a positive to the market and potential clients. Although I think it should be noted nonetheless that 58% do anticipate some level of reduction in leverage multiples. So that should obviously be borne in mind going forward. I do believe that banks, debt funds and ABL lenders will still always want to support good businesses, and certainly at Clydesdale and Yorkshire we're very much in this category with our growth strategy. And as I alluded to earlier, we've already been supporting both existing clients and new to bank event-driven opportunities recently. So that's very much our plan going forward, and I'm sure that's the case with my fellow panel members on this call as well.
Thank you, Alistair. I think it leads us very, very neatly into our next and pretty much final segment, the panelists' concluding thoughts, which I think Simon will take us through. But obviously, many borrowers on this call, and probably what we need is lenders' advice.
Thanks, Greg. Thank you to all our panelists, Donald, Alistair, Alan, Matt. Fantastic insights, good discussion. I think, Alan, before I ask all of you just to say a couple of moments, because I do want to get some questions from the audience. I think, Alan, you've got the prize from me at the moment in terms of the best takeaway being a rolling loan gathers no. So I think that is something else. So, Alan, do you want to kick off? Do you want to say just a few final observations before we get on to questions?
Sure. I think I said it on one of the earlier slides. The openness of communication between the client and the lender is just paramount. Understanding each other's points of view, clear communication, the visibility of the cash flow, the performance of the assets, talking those things through, and then understanding all of the options that are available. The C-bill scheme is a great scheme. I don't think it's been used quite enough yet. Good to understand what's going to happen thereafter, but I'll keep coming back to it. This communication piece is the key to me, and that's what works well within our portfolio.
Yeah, so no one going underground, no one going feral, just keep the lines of communication active.
Absolutely.
Right. Donald, what's your views?
Well, I hate to say it, I'm going to echo Alan. I think it's.
You're not going to say the same, are you?
Absolutely, I'm afraid. I do think it's about tough times. It is about communication, making sure that we have all available information, access to management, access to data, company financials, projections, enough time with management to make sure that that we are together with the management teams or the sponsor, making the right decisions, structuring in a way that's appropriate for the business, and making sure that businesses are viable, sustainable, given what are really unusual times. We don't want to be sitting here again with the same level of distress that obviously the economy is seeing, and some portfolios are suffering. We want to structure deals, transactions of companies that'll essentially see them through. If there's another shutdown or a next wave, we really want to make sure that we can build resilience into what we're doing, and that really needs that needs time with clients, time with prospective clients to structure properly and build flexibility into financing structures.
Yeah, and I guess it's also just picking up what you said there, Donald. Just working together. You're on the same side of the fence. Just working together on structuring and that resilience into the financing of businesses. Alistair, your final thoughts?
Yes, thank you. I certainly agree with what Donald and Alan have said there. I mean, very much just keeping the lines of communication open, talk to us regularly, keep us informed and updated, especially if you foresee any trading issues ahead, because we're going to be in a much better position to help with any covenant resets, capital repayment holidays, or even further funding support that's going to be needed going forward. And in addition, we can help really find solutions and potentially take advantage of opportunities to help you in terms of your strategic growth, for example, potential acquisitions. And also, I would say, and I know this is a very obvious point, but really do keep focused on your cash flow, plan accordingly for further potential impacts on both a realistic and a worst case scenario, so that you have your contingencies planned ahead if needed. And also, really, despite this ongoing economic uncertainty and the doom and gloom that we're seeing a lot every day, there are nonetheless still good levels of liquidity in the debt markets today. And so, certainly from a Clydesdale or Yorkshire perspective, if we can help in any way, then please do let us know. And that's it from me.
Thanks, Alistair. I think the same sentiment goes for everyone. Just reach out to us if you need support. Greg, I feel awash with pie charts, but what I think will be really interesting is perhaps to repeat that survey in the winter months and just see if we can track sentiment, see how it's changed. But there was one early slide you pulled up which showed the low take up on C-bills. Just wonder what your thoughts are on that in terms of what can be done to improve that take-up? What could businesses do, in your opinion?
It's an interesting one, actually. I was surprised by that. There has been, and again, a little bit goes to timing. So what we found, there has been a second wave, a second spike, actually, in those C-bills applications in the last 2 weeks. As what I think maybe the survey reflects is back in March, April, people who felt they had a need that they could foresee took out C-bills. Others who had cash piles kind of said to themselves, well, I think I'll use up my cash. Whereas what's happening now is that a lot of the other government subsidies are coming away. So the furlough scheme, the tax type schemes, and that's turning more and more people to think, well, if now what I'm really thinking about is through to 2021, through what we expect to be quite a difficult economic period, and with some of the economic subsidies coming away, the take-up for CBILS is I very much think, likely to increase as we go through the summer. Okay,
thanks. Yeah, let's talk about Alan. I'd appreciate your views on this one. The UK GDP is back to July 2002 levels, and I think yesterday's GDP announcement was a 1.8% increase, so a small increase. On the basis of that, do you think we're at the bottom of the cycle? Do you think April was the bottom of this economic downturn, or should we be cautious going forward?
I think it probably was the bottom. I'm still a bit bearish about this. Internally, we've got a mix of views on it, but I'm still a bit bearish. Our clients are now starting to see some increased levels of sales, and we are seeing it coming back through our books, and receivables are increasing. But I think confidence is going to take quite a while to come through, and as a result, yeah, I see this going on for a bit of a time yet, I'm afraid.
Yeah, I tend to agree. I think this is a minimum of a 5-year climb back. Donald, what do you think on that point? I mean, are you seeing any different lender sentiment across Europe compared to the UK as well?
It's a good question, and yes, we are. We're looking at businesses currently looking at transactions in far away as Finland, Belgium, Netherlands, and the sentiment is much warmer. It is, it's not so much back to normal, but it's very close to it, really. The extent of GDP declines, I think, particularly in Finland, but even Belgium, Netherlands, probably wasn't as deep, and the bounce back perhaps has come sooner. And they don't have the overhang, even psychological, kind of the Brexit overhang that again might weigh on the sentiment. I do think we should be seeing strong GDP growth just because we've gone so far. But I agree with Alan. We're going to have. I think we are cautious, but we are seeing some surge in revenues. But I think we've got an awful long way to go, and I do think it'll be it's a 2 to 3 to 4 year time horizon, unfortunately.
Yeah. I mean, it's interesting. There was a report from the US in terms of their congressional budget committee. They were forecasting that it's going to be 2029/30 before we be back to pre-C19 economic levels. Well, in the US anyway, which just seems far too pessimistic at the moment. I suppose linked to that is there was a question: is if there's a second wave of COVID-19, are we to expect all types of lenders to retract? Alistair, what do you think?
Yeah, it's a good question. I mean, I would hope that we've learned a lot over the last few months, and clearly we saw a national lockdown. But actually, when you're seeing spikes locally, it's more the local jurisdiction that's getting locked down. So I think the government are trying to avoid any more national lockdown measures, and so hopefully that will be a good measure of experience learned in terms of how we operate as a country going forward. So I'm more optimistic than some of the negative sentiments that have come through that have been mentioned. And clearly, if we can get a vaccine, that's going to be a massive boost. And clearly, there's different sentiments as to how quickly that will or maybe not arrive. But I think that the lessons learned, the fact that the government and the banking fraternity, along with debt funds and my colleagues on the panel here, been very supportive to clients to date, and the fact that we want to see capital deployed and companies being supported going forward.
Let's just take that. You said you're reasonably. I'm just conscious of time. But you said you're reasonably positive on that? So let's say on a scale of 1 to 10, 1 being, or 10 being incredibly positive, 1 being as doom mongering as you can get. Where are you, Alistair, on a scale of 1 to 10?
I would say I'm around a 5.
A solid 5. Alan?
I guess so probably a 4, but in terms of where we are as an organisation, we're still in the growth mode. We're still part of the market where we have the ability to grow. So we're still very much open for business. So I'm thinking that I'm bearish about the more domestic and global outlook, but while still quite hopeful that in terms of where Lumia will sit in that market, that we're going to grow quite nicely during this period, because our asset-based lending solutions are set fair to be able to help businesses come out of this.
Okay. Donald, same question?
Yeah, I think on a macro basis, probably, same as Alan and Alistair, around 5.
I was trying to get one of you off the fence. Greg, come off the fence. Where are you, Greg?
I think the market. I think the market's resilient. So I'm on the optimistic end of things, but I think
5.5 then.
Yeah.
Matt?
Sneak over that. That's right.
I'm a restructuring person, so as you might expect, I only ever see businesses that are underperforming. So my views are slightly skewed, but I do think over the course of the next few months there are going to be a large number of SMEs in the UK economy that are going to struggle to come out of their current predicament, whether that's because of the levels of creditor overhang, HMRC debt, unpaid creditor bills. So when some of the government's initiatives are unwound, I do think there is the potential for quite a significant jolt as people try to get their feet back on the ground.
Yeah, no, understood. Thanks for that. I'm just conscious we've just run over by a couple of minutes, so let's draw this to a conclusion. Once again, thank you to all our panelists for their time today. That's been really fascinating for us to hear. In terms of if you want any specific insight or information or advice, please drop us an email. We've got a COVID-19 inquiries website address, which hopefully will pop up on the screen any moment now. And if you can also visit, just a reminder to visit the RSM UK website, where you can register your preferences for any material that you'd like to be sent from the RSM team. I don't know, Greg, if we've got that final slide, just so we can see the one more. There we go. The COVID-19 inquiries email address is what you need to send. So that's it, everyone. Thank you again for your attention and your time today, and thank you for the panelists. That's been fascinating. Take care. Stay safe, everyone. Bye-bye.